Namaste. I welcome all the members who are here to understand the particular topic related to the committee and being organized by the Committee on Economic, Commercial Laws and Economic Advisory. I further welcome you all on behalf of CA Dr. Rajkumar Adukia, the Vice Chairman of CECLEA, as well as the CPE Committee, and the Vice Chairman, Sir CA Hansraj Chog. We are here with two renowned faculties who have already taken out time to share with us the various areas where we can extend the practice, and we can gain the maximum from the knowledge that we have and from the knowledge that we'll get from them. So these two faculties, the first session 4 to 5 is with CA Rashmi Shah. The second session goes with Prashant Das. He is from IIM Ahmedabad. So first we have Rashmi ma'am over here. A short profile about ma'am so that we have an idea about what she's been doing. And obviously at 5 o'clock we'll have Prashant Saab, and obviously that the session will be followed after I introduce him. So CA Rashmi Shah, I welcome you ma'am to the session over here. And for you all to know that CA Rashmi is a fellow member of the Institute of Chartered Accountants of India. She is also a registered value under Section 247 of Companies Act. She also holds international certification in banking risk management, facilitated by the Global Association of Risk Professionals. She has earlier worked with PwC, Bank of America, Chrysler, Standards, and Poor's for more than 9 years. Subsequent to which she is heading her own valuation practice for close to 9 years. So she's an example for a lot of people that they can start with such work, such businesses, and obviously prosper. And I can see from the smile on ma'am's face that she's enjoying this work in terms of delivering as well as in terms of commercials. Ms. Rashmi specializes in valuation space and has conducted valuations for many listed companies, large and small corporates, banks, financial institutions, and private equity funds. CA Rashmi Shah is an active participant in ICI activities involving valuation matters. She's a member of Technical Study Group of the Valuation Standards Board of ICAI and was also involved in drafting ICI valuation standards. That's really good. She has authored several articles and publications, including for Handbook on Valuation published by the Chambers of Tax Consultants. She was a faculty in ASOCHAM conference held on valuation and is a faculty on valuation course conducted by IICAI RVO. So, ma'am, from here you take it ahead and enlighten us with whatever you have and whatever you want to share on the given topic for today.
Thank you, Dr. Salim Khan. I'll just share my screen. So I would like to thank you all for having me for this session today, and good afternoon to all dear participants. In the next 45 minutes to 1 hour, we'll be discussing about the content and structure of valuation reports. We will be discussing the minimum content of a valuation report, the key requirements for preparation of valuation reports, both for fulfilling the valuation requirement as well as for maintaining sufficient and appropriate documentation. We'll also go through, a sample report, and we'll just see what a general structure of the report should be after considering the basis of preparation and documentation requirements. So here I must tell you that the company's Registered Valuers and Valuation Rules 2017 and the ICAI valuation standards, they clearly spell out the basic requirements or the bare minimum requirements for a valuation report. For this session and for my general day-to-day practice, I do take cognizance of these, in full faith and manner. Now, while the general framework of our valuation standards and guidelines, they are required to be followed. In general, there may be some deviation, when the valuer is required to follow the requirements prescribed by any law or by any rules or directions of any government or any regulatory authority or other regulations or a court order. So, yes, this session will aim to give you what a general report should look like, what its contents should look like. But nevertheless, it depends, on the nature of the engagement, on the kind of valuation you are undertaking, on the instrument that you are valuing, and also the actual purpose and nature of the overall background and transaction. So today we'll be covering the objective and context, the various valuation purposes, the contents of a valuation report, what management representation is, basic documentation, and then we'll just see some examples of what the contents and structure should look like. So as valuers, if we just present, our Excel model or Excel workings to somebody, it can be very difficult for them to comprehend what we are exactly trying to say and what our final value is, what our conclusion is, what our recommendation is. So we have to document everything for the user, for the intended user of the report. So as a valuer, we have to document everything that we have considered for arriving at the final value, and which will, in future form as the backup or the basis for the value that has been opinionated by us. This report has to be narrative and descriptive, explaining our Excel model, whatever we have put in our workings and in our analysis. There should be a reading or a narration, just like a story in our report. Having said that, throughout the session, I will not disclaim that it differs from case to case. You may be required to have a shorter report or a more concise report depending on the purpose. But on a general level, say 80%, 90% of the times, this is what you can and you should follow. So the report should be narrative and descriptive. It should explain the value that you have finally recommended and the overall procedure as to how you have come and to that value and arrived at the value. You should start with maybe basic data to the various inputs and assumptions, the valuation methods that you used, the approaches, and finally the value recommendation. This list is of course non-exhaustive, and we will therefore focus more on what is the bare minimum that will be required by us as valuers in the report. We are preparing these reports to explain the genesis of recommending a specific value for a given valuation purpose. And that is why our report should be as reflective of the work undertaken by us, not only in terms of reasonableness of the value, but also with a very clear and concise explanation which can support our final opinion and conclusions. There are various valuation purposes for which we can undertake valuations. So it could be for transaction, M&A, individual purchase or sale, for accounting and financial reporting, for regulatory compliances, like for provisions of Companies Act, for SEBI compliance, for SEBI regulations, income tax, wealth tax, RBI compliances, for general consulting and support and internal management analysis, at times for fundraising, for insolvency and bankruptcy proceedings, for taxation or general gift planning. So these are basic purposes. Of course, we can have many more purposes other than what is enumerated here. But generally, these will be falling under the basic purpose of undertaking a valuation and finally revealing the value recommendation. So what do you think are the contents of a valuation report? So some basic contents would be these. First is the background information of the asset being valued. So what are you trying to value? Is it a company, or is it an instrument like a preference share or an equity share or an ESOP or some intangible? You need to give some information about it. If it's equity shares of a company, then what is the company? When was it registered? Basic things like where is the address? What is the SIN? What's the shareholding pattern? What is the company doing? What's the profile? Maybe directors of the company, and the list could be as long as we like. But yeah, basic details along with the historical and projected financials of that company and analysis on that. That will give us a good understanding of the background information of the asset that we are valuing. So if it's an OCD, then what are the terms of the OCD? What are the redemption terms, conversion terms, etc. We'll need to mention them in the report at the latest. So yeah, basic information of the asset being valued. Second is, what is the purpose of valuation and who is the appointing authority? So that also should be very clearly stated and disclosed. Whether it's the board of directors or whether it's the audit committee, you may like to address the report to the intended user of the report. Third is identity of the valuer and any other experts that are involved in the report. So the person who is undertaking the valuation, along with his or her registration number, as well as the organization. At times, the individual could form part of the organization. So the details of that organization. And if there are other team members or experts or specialists which you have consulted, in your process of valuation, their names should also be disclosed. Another important content, whether you have any disclosure of interest or any conflict. So this is just required to ensure that there is transparency, and valuers are therefore required to disclose any facts which are relevant and which could be perceived to be as conflicting in nature at the time of undertaking the valuation analysis. So that's important to mention what kind of conflict you have and what is your interest in the subject that you are valuing. Date of appointment, valuation date, and date of the report. So when were you appointed? What's the valuation date? The valuation date serves as a cutoff date for most valuations, and date of the report, but that's the date on which you are signing the report. Again, your report should clearly specify these parameters. Any investigations, or inspections that you have undertaken. So if you have actually read through some documents, say for example, you are undertaking a purchase price allocation and you've gone through, a share purchase agreement, you should mention that, I have reviewed it and I've inspect maybe a strong word, but yes, I have reviewed the document. So a list of all documents which you've studied in depth for undertaking the valuation of the subject, you should mention that as well. Nature and sources of information used or relied upon. Extremely important. In your report, somewhere in your report, you should definitely mention what are the sources of information that you have relied on and who has provided that information to you. So yes, all principal sources, they should be listed very clearly. These typically will involve, company financials and projections, which management will generally provide to you. You could use public data like, share prices or other data from NSE or BSE or from websites. You can use CapIQ, you can use Capitaline, Bloomberg. So whatever you have used and whatever data and inputs you've obtained from these sources, you should mention that as well. Okay, so as professionals, you need to accurately state what you have relied on and which sources you have considered to, finally come to a valuation conclusion. What are the procedures that you have adopted in carrying out the valuation? So procedures can vary with circumstances. It can change or depend on the valuation purpose as well as the kind of information available with you. But yeah, generally the procedure will be that, you enter into the engagement, you sign the engagement letter, then you will ask for data, you will receive data, you will review the data carefully, you will then have discussions with the management, then you will zero down on the number of valuation, approaches or methods that are applicable. Then you will undertake the valuation analysis. Finally, you will issue a draft report and a signed report. So the procedures would generally mean this. From start to end, what exactly have you considered to give a final conclusive report? Guidelines require valuers to include an affirmative statement that the information has been provided and assumptions used by the management or others in developing the projections, they have been appropriately reviewed by us as valuers, and we have made sufficient inquiries for those projections, and to the extent the rationale is available for historical performance and estimates as well. So as an affirmative statement on adequacy of information and the time for carrying out the valuations should also be included in the report. Next and very important factor, valuation methodology. So definitely you should include what valuation method or approach you have adopted as a valuer. And these will include the various approaches. That's the cost, income, and market approach. You have to disclose that. The rationale and the relevance, for using or for considering this particular valuation method or a combination of methods in the given context of valuation should be very, very appropriately justified and should come out properly in your report. Okay, so your report should not only disclose why you are considering something, but it should also disclose and clearly, explain as to why you're ignoring other methods. Okay, so it should be a sum of various approaches and methods, along with why you are considering and not considering certain methods here for the said valuation. Major factors, restrictions on use of the valuation report. Now, if you want, your report should not be used to a specific or an intended party, you can put a restriction. So you can clearly add that the report is restricted for use by this party. You are free to do that in your report. Major factors that were taken into account during the valuation. So if there are any key material factors, so say for example, a lack of say marketability or lack of control or any control premium, you need to take care of all those in your valuations. So minority or majority holding, any changes in the shareholding at the time of the transaction. So any major factors that can change your value materially or significantly, it can have an impact. Say for example, regulatory requirements or any kind of other consideration and aspects, you should definitely factor those and also mention those in your report. Finally, we have conclusion. So your report should very, very clearly mention what the final value is. As the standard requires, you could give a single value or a range of values depending on the requirement of the report, ultimate requirement of the report. And also you should mention why, if you've used more than one method, then why and what weightage you have applied to each method. Okay, so conclusion is very important. You should have a separate section for valuation conclusion in your report. Okay. Finally, caveats, limitation, and disclaimers. To the extent they explain or elucidate the limitations faced by a valuer, which shall not be for the purpose of limiting his responsibility for the valuation report. So yes, you can say that you are limited or bound because of certain factors, but it does not mean that you have complete leeway and you have complete flexibility, after just putting on certain caveats or disclosures or limitations. So they should be very, very clearly stated. In fact, the Insolvency and Bankruptcy Board of India, they have some guidelines on the use of caveats, limitations, and disclaimers in valuation report. So they mentioned that caveats, they are basically warnings. They are cautions to the users or, of services or the client for whom you're preparing the report. Limitation is like a restriction. As a valuer, you are restricted and your scope of work gets restricted, maybe because of unavailability of data or because of anything outside of the valuation engagement, because of which you are not able to carry out your work in a reasonable manner. Disclaimer is something which is trying to delimit the scope of rights and obligations which an other party can actually put on you legally. So it's like you're denying responsibility intended for any civil liability that could arise because of an act or an omission. So they all are different connotations, but ultimately I think they overlap somewhere and they are interchangeable in one way or the other. However, you need to, as a valuer, you need to mention all disclaimers, all limiting conditions, caveats in one different section of the report, and it should be very, very appropriately and clearly specified. However, it does not mean that as a valuer, you are free from your, duty of due care. There is a recognition that you are getting information from the management, but yes, though you are not liable for probably its correctness or accuracy, but you need to still have a check of the reasonableness of what you are getting. Okay, and it also has to be tested and corroborated accurately, appropriately. Some important considerations while drafting the report. Okay, so the first one is that using the work of another expert, and you can also disclose it in your annexures. So where as a valuer, I'm using work of an expert during the process of valuation, I need to disclose the identity of that expert and what kind of reliance I have placed on this expert. Okay, so say for example, you're doing an 11 UA working and you need help in the stamp duty valuation from a technical valuer, who's a land building registered valuer. So you should definitely mention that you have relied on the workings of this valuer, and you can annex this report actually in your report as well. Okay. So second is with respect to independence. So what this means is that as valuers, the general presumption is that you are expected to be independent, not only independent of the asset to be valued, but also to the client or any intended user at the time of carrying out the valuation. Now, if there is some law which is prohibiting you from accepting the assignment as a valuer, then definitely you should not accept that valuation engagement. You then need to also mention the valuation basis for undertaking valuation of any asset category. What valuation bases are? They basically describe the fundamental premises on which the value will be based. As a valuer, you can give a combination, or you can use a combination of methods and approaches to arrive at the final value. You need to disclose the approaches and methods in a very detailed and comprehensive manner. And you also need to say that your valuation is in accordance with ICAI Valuation Standard 103 when you are finally concluding your value. And this you may or may not give a single or a range of values. It depends on the end result. Okay, so you can give a single value, or you can, if there is a requirement to give a range of values, you can do that as well. Okay, so you need to give the final conclusion either as a single amount or a range, but some value definitely has to be there. So yeah, in certain cases, there could be a regulatory requirement that could require you as a valuer to report a very specific amount. In that case, you give a specific unit. And in other cases, you may also give a range of values. In some reports, like a merger report, you may have to give a specific exchange or a share swap report based on the values derived of the companies involved. And caveats, limitations, or disclaimers, this we have already discussed. So yeah, valuation results and analysis, they are definitely, they are all subject to, or they are bound by the purpose, by the requirements of the client, by the valuation date and other factors. So your caveats, limitations, or disclaimers, they form an important part of your report. But yes, they are considered, they should be clearly disclosed in the valuation report. But at the same time, the valuer's duty is to exercise reasonable restraint or reasonable control while using these caveats and putting them in the valuation report. But yes, over and above this, if as a valuer you feel that you want to disclose more, you are free to do that. But just make sure your report is not diverted and your mainstream is not losing focus. It should be crisp, but at the same time, it should cover all the key ingredients. It can definitely be more detailed. And that is, a discretion of the valuer and the ultimate user of the report. So what are management representations? Once your report is, it's formed, a draft report is ready to get signed, you can obtain a management representation. It's basically a letter which the management will, provide you with all the information and inputs that they have provided to you. So say if they've given you financials, they've given you projections, they will put all those in a representation letter. They will sign it on their letterhead and they will give to you. As a valuer, it's your discretion whether you want to obtain that letter or not. It's very good to have because management itself is signing on something and giving it to you. So you should keep it, you should obtain it and keep it. But yeah, the decision to obtain a representation letter is a matter of maybe discretion of the valuer here. This written representation, it can form, a source of evidence by the valuer, which also forms a basis of working papers for the valuer in the future. In the report, the valuer should also always mention that he has obtained representation and he has also placed reliance on the data that has been provided to the valuer. Yeah, but again, as a word of caution, just because you have a management representation letter, it does not exclude you from exercising any reasonable skill and care while drafting the report, while undertaking the whole valuation analysis. So whatever information you obtain, you should definitely carry out your procedures of testing and then use it to get the ultimate value that is there. Okay. So what is documentation? Documentation is basically, it's a record, or it's a whole data pack of what valuation procedures you've performed, what kind of information and data you have received, and what data has helped you, conclude the final value as a valuer. So you need to obtain sufficient and appropriate evidence in arriving at the conclusions, which will definitely form basis of your valuation report. This information obviously should be received in a timely manner between, as per slated timelines. And you need to exercise, of course, your professional judgment, needless to say, after receiving all the data as well. You can retain this information as well as all your analysis, your workings, your assumptions for a period of time, which should be sufficient, okay, to meet the needs of any regulatory or other professional requirements or legal requirements for records retention. The retention period as per standard for valuation document is generally not less than 8 years from the date of the valuation report. And you are allowed to maintain this documentation in both physical or electronic basis or format. Okay. So some of the key documentation requirements that you should have is engagement or appointment letter, which appoints a valuer to undertake the valuation. Tabulation of data which you have obtained during the course of valuation. The workings that you have undertaken to arrive at the value. The copies of relevant circulars, extracts of legal provisions. Okay, so if you have relied on any circulars or provisions, so say for income tax, you're doing 11 UA. If you have relied on Rule 11 UA, you should have, at that point in time, the current provisions should be there with you. They should, in fact, also form part of your report. Okay, because maybe 5 years hence or 3 years hence, the provisions can change. So you should have it with you as of the current date, even in your report. And all these should also form part of your report. Of course, engagement or appointment letter being a separate document altogether. But yes, all the data that you have obtained, all the workings, relevant circulars or legal provisions that you have referred to, the basis or approaches and methods used to arrive at the value, all the assumptions that you have used, which may materially affect the value if they are changed, and the copy of the signed valuation report. But yeah, point 2, 3, 4, 5 and 6, they should definitely form part of your valuation report. And finally, as we discussed, a management representation or a client representation letter or any other form of communication whereby management is confirming the kind of data that they have given to you. We'll now go on to some examples of the contents and the structure. So these examples, they are extremely open, as in you could have a different format and you could use a different layout and you could use a different language. It depends. But we'll just discuss the basics, which you can have. It's good to have in your report. So when we spoke about background information of the asset that you're valuing, so it's basically the details about the company, like the date of incorporation, its corporate identification number, its registered office, address, shareholding pattern. You can also include the list of directors that were there at the time of the valuation. So this is, you can just say that XYZ was incorporated as a private company in India with its registered office. The sin is this. And the company is engaged in the business of. It's very important to give a brief description of the business of the company. Its share capital structure you should give. The names of the shareholders, how many shares each shareholder is holding, what's the percentage shareholding looking like. So these are very important. You can give a list of directors. If you have good amount of access to data, you can also, put information like, top 10 customers, top 10 vendors of the company, it's the milestones that it has captured. So it all depends on how long the company has been into business, the history of the operating history of the business. If you have more data, you can definitely put it, but make sure you're not delineating from the original matter that you are trying to showcase. If it's having an impact on the value, you should definitely mention all that. Don't load your report with unnecessary information which is not even impacting your value. These are the basics, and you should definitely have in your report. Second part of background information is historical and projected financial analysis. So yeah, you should definitely put, what has been the past like for the company and what's the projection looking like. They should definitely be in a trend, and that's where our reasonableness check will come into play. So yeah, you can give your historical and projected income statement and historical and projected balance sheet. And then you can give descriptions about, what the revenue looks like, what is the growth of the revenue, where does major part of the revenue come from. If there are various segments, you can give some allocation and breakup. What is the composition of expenses? What's the final EBITDA? What are the margins looking like? What's the tax rate applicable to the business, depreciation, etc. So all of these, you can explain your P&L in a comprehensive manner and explain the major items which form part of your profit and loss statement and which are also getting into your projections to finally get the value. Even if you're not using projected data, you are using, say, NAV method, then definitely you should explain your balance sheet very well, and also see whether your fair values have been adjusted appropriately or not. Likewise, for historical balance sheet, you say what are the balance sheets that you have considered for historical trends, and then you can break down your equity, your borrowings, or your other liabilities, fixed assets. These are only examples. Your asset liabilities could have many more items. So you should try and explain. If investments, there is more than one, you should break it up, and investments, they are forming a key part of your balance sheet. Then you can also break it into liquid investments and unquoted securities and investments in joint ventures. So depending on the kind of business you're valuing, you should try and be descriptive about the company that you are analyzing. So you should mention about the key components of the balance sheet and P&L statement. Now, who is your appointing authority? So you can, you can put the board of directors of the company, or you can mark it or, address it to, the key person or the authorized personnel, or you can also address it to the audit committee if there is an audit committee for the company. So appointing authority should be mentioned very clearly at the start of the report. Very important, valuation purpose. This purpose should always be in line or in context with the engagement background. Why do you need the valuation? So that is where the relevance comes of the purpose. So yeah, some company wants to issue shares to someone, and that is why I am required to undertake valuation. Okay, so your company A wants to issue share to another investor. So that is why I am required to undertake valuation under what? So you can also very clearly mention the rule, the section, the provisions, and the regulator. Okay, so in your first example, it's for Companies Act compliance. In the second example, the shareholder wants to transfer equity shares to other shareholders. So here, another section is implicated for income tax. But yeah, you should clearly mention that it is for section 56 to 10 and section 50 CA, and also mention in brackets that it is the valuation purpose. So this becomes your valuation purpose. Always give your purpose in context with what the engagement or the transaction background is. This is another example. Here a non-resident investor is involved. So there is one share being transferred to a non-resident investor. And that is why in capacity of a chartered accountant, you have undertaken the valuation for FEMA under FEMA regulations. You should also mention, so say if you have more than one letterhead, you are a registered valuer also and a chartered accountant also, where you are required as a chartered accountant, you should clearly mention that this and chartered accountants, that has been appointed or engaged. And where Companies Act provisions are there, you should specifically mention it's a registered valuer. That is also required to form part of your valuation purpose. So the party ultimate person or the valuer who's going to sign and in what capacity, that should also be clearly stated in the report. This is one example of a purchase price allocation. So here also we are saying that, there is some acquisition and valuation is required under Ind AS 103 business combinations. So you have undertaking PPA under and you have also considered Ind AS 113 for fair value. So whatever you have considered and you just explain the transaction and then you explain the overall purpose of the report, because this forms your basis. Everything follows after your purpose is defined properly. When you are defining or when you're placing your purpose, you should also be very clear of the premise of value and the basis of value. As per valuation standards issued by ICAI, there are 5 premises of value. So what is premises? Basically, it refers to what conditions and circumstances an asset is deployed into. Okay. Generally, highest and best use and going concern value is a must. Any asset that you're valuing, you have to make sure that there is a highest and best use of that asset, and the entity is in the going concern bracket. So highest and best use, and there is going concern value. Then there is as is where is value. Then orderly liquidation and post transaction. So depending on what state your asset is in at the current moment, you should define your premise of value. Should also mention that this is, as described or as required by the valuation standards prescribed by ICAI. So here, this is the premise of value. There are 3 bases of values prescribed: fair value, participant specific value, and liquidation value. So fair value is by far the most adopted. You should definitely mention what the basis of value is. If there is an investment specific valuation that you are doing, then you can also mention that this valuation is not considering the market participant perspective, but it is a investor specific or participant specific value. If the company is going into liquidation, then the basis of value becomes liquidation value. The idea is that your premise and base of value should be very, very clearly mentioned in your valuation report. You can have a different section for it. You can, include it in your background. It depends on you, how you want it, but you should include it somewhere in your report. Next is identity of the valuer, and you'll also see the contents of signature of the report. So when it comes to identity, you give the name of the valuer, you give your address, you give your qualifications. Then you can say, you're a registered valuer under this securities or financial assets category, and you are also a practicing chartered accountant. Do you have any disclosure of interest or conflict? You can mention. If you don't have any, you can write none or not applicable. Was there any other expert involved in the valuation? If yes, then you give details, and you can give details of the report that you have considered. Also it should form part of your annexures. If not, then you can write none or not applicable. So these are the key for identification of the valuer. Now we'll see the signature of the report. Now standards also describe what your report, what your signature on the report should look like. You should have your name. If you are under a firm, you should have a firm name. If you are a chartered accountant, you should clearly mention your ICAI membership number, your firm registration number, your location, the date of signing the report, and ICAI UDIN is necessary for all practicing CAs, whether it's you're signing as a capacity of a registered valuer or a practicing chartered accountant. You have to generate UDIN as of the date of the report and also mention it in the report. So your signature should be comprehensive. You should have basic details of your registration, the location, the date, ICAI UDIN, your name, your firm's name. These are the basics. And when you are signing, you should definitely have a stamp of, before signing. Then the content required: date of appointment, valuation date, and report date. You can have a section or you can write it in text format. The idea is to have it somewhere in the report. So you can say that, our engagement letter, via our engagement letter, we are undertaking this valuation. You can put your engagement letter date, that becomes your date of appointment. And you can put the valuation date as well as the report date. At times, your report and valuation date could be different. So that is why it becomes important to, mention those dates categorically, so that the intended user is very clear and he knows what the dates look like. Sources of information. So you should have a section for that as well. You can say that there are some sources of information which we have obtained we have obtained from the management, and we have utilized in conducting our valuation. And you can write, whatever you have used and obtained from the management, you can definitely put in your report. So here I've mentioned it's the audited financial statements. Then there are projections. Then I have I've had discussions with the management about the historical performance and estimates of projections. Then there are details of contingent liabilities, the shareholding pattern, some publicly available information. All of that you should mention. Whatever you have considered for undertaking the valuation, you should definitely mention under sources of information. Your report should also contain a section called the procedures adopted and standards followed. So these are some common procedures, but very honestly, if you are free to define this section the way you want. You can say I've received and signed the engagement letter. Then I have received preliminary data. I have reviewed, I have analyzed all historical and projected financials. I have done an industry and SWOT analysis, if at all you have done, which you should do. Then I've also, undertaken a comparison with similar transactions and some other listed companies. I've had discussions with the management on the data that they have provided. I've, reviewed the documents or some principal agreements. I've considered various valuation approaches and methods which, have suited the specifics of the business and of the company as well. I finally prepared the valuation working and synthesis of the assumptions and inputs, and I have issued draft report to the client. These procedures are important because it gives a brief, snapshot of how you have arrived at the final value. So you should definitely give the procedures that you have adopted and the valuation approaches and methods that you have used. All of that should definitely come here. Next section is valuation approaches and methods that you have used. There are various ways to present this. There is a lot of, theory that is there on these as well. But do not overload your report with that. Keep the key points and the points which are relevant for the valuation. Okay. You may put tons, of information about DCF, but you are actually using market approach. Then that DCF method information is irrelevant. So you, as a valuer, you need to be, a good director also of your report. If you don't require certain sections or it's more of an explanatory form, just give it as a gist. But basically, this is what you can say, that there is income, market, and cost approach. Within the three approaches, these are the key, valuation methods, and a brief of what they are. You can give more information also, but don't divert from the main method that you are using. After this, there should come one more section where you, again, it's up to you how you want to present, but you should mention as to why you are considering some, methods, or why you are ignoring some methods or not considering some methods. That section is extremely important and it should definitely form part of your report. So you should include the table or a text format or a paragraph format, whatever you want. It is a must. You should definitely have the approaches and the methods and the key methods that you have or have not used for valuation. I've seen some methods which have a form of a matrix where they say that, they put a tick mark, okay, that this method is needed, this we have not done, and then they give an explanation. So it depends on how you want to present your report. These are just some valuation methods, some of the important ones that we would use for business valuation. I would like to mention that if you're valuing ESOPs or intangibles, the valuation methods will change. Okay. So this is for equity specifically. You can use DCF, CCM method, market price, comparable transactions, price of recent investment, net asset value, or replacement cost. Okay. Any of these methods or any of the methods beyond this. This is just a snapshot. Finally, valuation conclusion. So we say that, okay, I've undertaken an analysis, and based on my analysis, this is the value, the total value of the subject as well as the per unit value of the subject. Again, it differs. At times, if you are just valuing the business, okay, you may just give the value of the business and there is no per unit value there. It depends on the end use of the report. But yes, you should say that, what procedure you have used and in what capacity are you signing. So this is a good to have paragraph. Then you can also say that, okay, within the various approaches and methods, I have considered DCF method under the income approach, and it's an internationally accepted pricing method. This is probably a FEMA report, and that's why we are harping so much on internationally accepted pricing method. Every section could be different. If it's an 11 UA report, we can say that it's prescribed by Rule 11 UA. It's a very specific format, and it cannot be used for any other valuation purpose. All right. So this is not the final or the only way to present. Your language, your theory will always keep on changing depending on what you are valuing and what you have used. Okay. And then I'm just referring that, okay, you can refer to the valuation analysis section for an explanation on what inputs and assumptions I have finally used. These are a brief list of caveats, limitations, and disclaimers. I have seen I've seen a good amount of disclaimers and limitations. You are free to do that. The only requirement of the authorities is that, do not preclude yourself or, do not contain yourself from any responsibility or duty of the diligence or the care that you have taken while undertaking the valuation. So though I would have said that I have relied on information, I've also said that I've broadly reviewed all the information that's provided to me for reasonableness and completeness. But yes, I have not undertaken an audit and due diligence, which is also a fact. Okay, this is a small gist. There can be various caveats and limitations depending on what you are valuing and the actual limitations that you would have faced as a valuer to undertake the valuation. Yeah, so this is about it. We can take on some questions. I think I'm in time for completing this presentation. If we'll go through the questions and then we'll say, I'll show you maybe one structure of the report. So this is, okay, I have a question, but it is not related to this topic. It's for web admin. So I have 5 minutes. I can show one report, which is a sample report, just to see what the structure looks like. Oh, sorry. I hope you all are able to see my screen. So I'm saying, yes, I'm giving the name of the...
Your screen is visible.
Okay, thank you. Yeah. I'm saying, I'm giving the name of the company, and then I'm saying what I am valuing. What is the valuation subject here? So it's equity shares and CCPS of this company. What is the report date? It's actually a good thing to also put the valuation date here. So you can put both valuation and report date. But it depends on your comfort. You want to put it on the first page or you want to put it at the time of signing. It's your comfort. This is just your letterhead. I'm addressing this company. You can remove audit committee. You can put it to the board of directors, depending on which company you're valuing. So then I'm giving a brief overview of the transaction. Then I have given the valuation purpose, and I've given just a summary of what the value has finally come up to be. Then I've said that I've valued it as per internationally accepted methods. This is what my signature is. I've put in all the important details over here. This will be the contents of the report. So I've given again an engagement background, what is happening, what we are valuing, what the purpose is, and some conclusion on the value. I've given an overview, a brief overview of the company. As I said, you can include many more things that you want to, but don't overload your report with things which are not relevant for the valuation that you're doing. So this is a brief note on the valuation conclusion. I have also taken you through the slide. Here you can put after the conclusion. Now, why is it important to have conclusion in the front? Because, we don't want the user to keep scrolling 100 pages and then finally read the conclusion. So I've given the conclusion before, and now I will start with the analysis. Then I'm discussing about the historical and projected financials of the company. If it is relevant for your valuation and you have undertaken some economic analysis, always good to put this section too, economic analysis and basic indicators. You can give, you can have a brief note on industry analysis as well. And you give the valuation analysis. So you can put your DCF table here and you can, put, what are the assumptions that you have used? What is the discount rate that you have considered? How have you determined perpetuity value? What's the contingent liability? What's the share capital? You give a brief note on how you have computed weighted average cost of capital. Okay, like, just give how you got beta, how you got additional risk premium, what's the cost of debt, etc. And finally, the weighted average cost of capital that you have considered. Okay, then this is a brief on the valuation methods that have been considered. And this is a brief note on why I have considered. So I've written that's why we have not considered the cost approach, or we have not considered the market approach. And here we have considered the DCF approach. So it's important to give some justification and then mention as to why or why not. Yeah, so that's how the a basic report would look like. And we are open to questions now if you have. I think there was a 1 minute, some 20-second glitch from my side on the net front, but I was just concluding at that
We
time.
thought you lost the connection, and again, by the time we tried to connect to the tech team, you were back.
Okay.
So that was only, I think, 15-20 seconds.
15-20 seconds. But I was only concluding. I was just saying that this is a general structure of the report. Yeah.
So do we have any other queries, Krishna ji?
So let me check. Wait a minute.
Ma'am, in a nutshell, what would be the liability if there's some kind of lacunae or loose ends when it comes to the valuation report? Because this is something which the concerned chartered who are practicing in this, they should take care of what liability they have if something goes wrong technically somewhere. So if you could just take around 2 or 3 minutes, whatever time you feel you're comfortable with, and give some insight on that, because this is something very crucial they are going to report on.
So the liability as such is mutually decided by both parties. It is not mentioned anywhere that. So at times the client can say, one-time fees that we have paid to you, or you indemnify us for anything. It's more legal in nature. But yes, the liability, if I was to say, it's mutually decided. It's never. I don't think it's written anywhere that if you are faltering somewhere or because of your negligence, what could you be liable to? Generally, at the time of signing the engagement letter, your engagement terms will mention your liability as well as your indemnity clauses.
So there's nothing specific about that. So we need
not that I am aware of. Yeah.
Very, very nicely when you showed the particular forms, how it should go. That was really nice. If you could share the same, if it's not shared with us, then we can, even put it on the respective portal, so that, in case if it is required and as a sample, it was very Very nicely put across. Really, it was a very unique kind of a presentation that came up, and I'm sure the participants over here would find it really beneficial on their end for this.
Thank you.
So, yeah, thank you so much. Ma'am, I'll conclude over here for your session. We had CA Rashmi Shah, and I really thank you for enlightening us with the knowledge that you had, and also giving us an extension for an area to practice apart from what we are doing, so that we can add to our businesses, because growth is the ultimate thought and the aim for people who practice in this profession. So moving ahead, I'll welcome Professor Prashant Das, and he has a very lovely profile, and I would take a little bit of more time to describe what he is. And so you're really looking good today, and from your face I can find that enthusiasm of giving the inputs and taking it ahead. So here we have got Professor Prashant Das, who is a PhD. He's an associate professor of real estate, one of the most lucrative business in today's economy, finance and accounting areas, at the main institute, at the Indian Institute of Management, Ahmedabad IIMs. So really, it's an honor that I know the faculties who teach at, mentor at, or take lectures at IIMs and IITs. So I know the knowledge they have, the expertise that they have, and the entire fraternity is going to get a lot of things from your end. At IIM Ahmedabad, he's an executive committee member of the Misra Center for Financial Markets and a member of the Center for Transportation and Logistics. He's also visiting faculty at the University of California. Wow, that's really great. Irvine Business School. Earlier, he served as an associate professor of real estate finance, the director of Real Estate Institute, and a member of the academic board of EHL, Lausanne, Switzerland. Before Switzerland, he taught courses at the Robinson College of Business, Georgia State University, Atlanta, USA, as a PhD fellow. He has been visiting faculty consultant in India, Switzerland, and UK. He has been supervising, examining PhD theses in the US, UK, South Africa, and is amongst the top 5% journal reviewers in the world. Prashant has authored 23 research papers. That's really great, sir. And you can see, from your qualifications and the weightage that this has to follow for the international journals, and authored 3 books for Sage, Routledge, Kendall Hunt publications. He's currently working on 2 books on real estate. 2 of his papers have earned Best Paper Awards from the Journal of Real Estate USA. In addition, he has earned 8 internationally competitive research awards and teaching awards in USA and Romania. Since 2020, he has been serving on the editorial boards of the Journal of Property Research, Taylor and Francis, UK, and the Journal of Sustainable Real Estate, American Real Estate Society. His research interests include commercial real estate, private equity, REITs, MBS, and hotels, behavioral real estate, and sustainability. He has a special interest in real estate markets. Professor Prashant received his PhD from Georgia State University, Atlanta, MS from Texas A&M University, College Station, and he is a BS Architecture from IIT Roorkee, India. Earlier, he served on managerial and engineering roles with several firms organizations, including HCL Infosystems Limited and Tata Consultancy Services. In his free time, Prashant likes to write stories, poems, does oil painting on canvas travels, and sculpts in clay, very good, and wood. He is an avid consumer of ghazals. So this is really a unique hobby you have, sir. Especially when I read about when you sculpt in clay and wood, this really needs a lot of patience and a lot of, you are an artist, I would say. So, from here, sir, I welcome you to take ahead the session and enlighten us.
Mr. Khan, thank you very much for this very generous introduction. What C.A. Shah presented was such an insightful session. There was so much for me to learn. And I was able to build bridge between what we do in real estate valuation and what she showed as, a business valuation. And there was an uncanny degree of similarity. And no wonder if Ms. Shah does all sorts of valuations. And I presume that real estate is one of them. I would take this opportunity to thank Mr. Rajkumar Adukia, Dr. Adukia. I've heard about him, great things about him from many different segments of the society. I had the privilege of having some discussions with him. I would also like to thank Mr. Amit Kedia for introducing me to ICAI. Ladies and gentlemen, this is the first time that I'm talking to a group of chartered accountants who are already experts at what they do. And unlike Ms. Shah's presentation, which was, very useful, practical insights related to how we prepare valuation reports, I will take the topic to a slightly abstract level. So my presentation today will be more about building insights on what leads to prepayments and defaults in real estate loans. That is not to say that it has no implication on valuation. In fact, when we look at the portfolio of assets owned by lenders or in the secondary mortgage market, these hazards, as we call them in academies, prepayments and defaults, have a major impact on how those portfolios are valued. However, today we will not focus on valuation. Today we will focus on what leads to prepayments and defaults in real estate loans in India. In particular, I will start with a brief overview of the mortgage markets in India. And then I will discuss two research papers. Very briefly, I will show you some findings from the research papers that we have been working on. I'm Prashant Das, as a member of Mishra Center for Financial Markets and Economy from IIM Ahmedabad. I'm very glad to introduce to you my colleague, Ms. Purvi Anchalia, who is a research associate here and who has helped in preparing this talk. Okay, so as a student of real estate, I find Hi, Purvi, we can hear you. Yes. I find Indian real estate market to be extraordinarily unique, because the way we look at real estate assets in India is very different from how other people in similar nations across the world look at real estate. For us, investing in real estate is a matter of emotion. It's a matter of pride. It's a matter of social security. To some extent, it's a matter of ego. And as much as we would like it to be an investment decision, for most of us, it's a very personal decision to invest in homes. When you look at the affordability index of real estate in India, we are among the worst rankers in the world. In other words, real estate is more unaffordable in India than in many other similar countries, let alone developed countries in the world. Despite that, we have a tendency not to take a lot of mortgage loans. So if you look at this graph here, this is the mortgage penetration level, and it's hardly 11% of the total GDP in India. Whereas in most other similar countries, this would be around 30 to 35%, at least on average. That means that we not only spend a large part of our income and savings and potential future savings into buying homes, we also do it with our own equity capital. And that doesn't mean that the mortgage markets in India are any small. We are still talking about a mortgage market worth $300 billion in India. And no matter how small in proportionate level the mortgage markets in India are, we are talking about a monster that is still sleeping. And as the awareness about mortgages in India will increase, this will become a market that the rest of the world will be talking about. And hence, it is extremely important for us to understand what makes this market and also what kind of risks this market is exposed to. If you look at the portfolio of mortgage loans in India, nearly 57% are issued by scheduled commercial banks, and nearly 43% are on average, this is 2019 data, issued by what we call as housing finance companies, or HFCs hereafter. So there's a pretty decent distribution between commercial banks and HFCs when it comes to giving out mortgage loans or home loans in India. If you look at the overall portfolio, here the numbers you see in the top box is numbers explained in described in lakh crore rupees. So you see HFCs have been giving out around 8 lakh crore, have given cumulatively 8 lakh crore rupees in total, and the banks have given around 16. So the distribution is around 67% to 33%. However, when you look at the growth of loans being given out by these two sectors, HFCs are growing at a CAGR of around 13 to 14%, and SCBs are growing at around 10 to 11%. So clearly, HFCs are claiming a big piece of the pie, and they will perhaps be the dominant players. Now, HFCs are only one segment of what we call as NBFCs, non-banking financing companies. And when we have a look at the overall statistics of NBFCs, which do not necessarily deal in housing which are not dedicated for housing finance, you will see that even there, the majority of the loans given out are in the housing sector. And we are talking about 51% of their portfolio going towards housing, 27% towards auto, and the rest for everything else. Clearly, and when you look at the growth of housing loans, it's still 13%. It's much higher than the GDP growth. And that clearly shows that we need to pay attention to this segment of the market. And if this segment goes bust, it is going to be devastating for the overall economy. And no wonder government policies always stand up to all the economic challenges that come. And one of the first things that they try to safeguard is the real estate markets. So who, on the other hand, when we talk about financing institutions that are focused on housing, who is giving these loans? We see that clearly the public sector banks are dominant players, but they only dominate in the affordable housing segment, 35 lakhs and below. On the other hand, are private sector banks who tend to dominate in the high big ticket mortgage loan segment. And then we have these HFCs, which have equal exposure among all the segments. In other words, there are some lenders which are more exposed to a focused group of borrowers, while some others are exposed to all sorts of borrowers. And I'm trying to get to a point here. When you look at the ownership pattern of HFCs, which are almost equally distributed across all ticket sizes of mortgage loans in India, you see that a lot of their capital raising has direct implication on common public, whether it is from government companies or public limited companies. This is common people's money, your money and my money, going into the housing finance companies. And we as a nation have to think and have to worry about and have to be sensitive towards how to safeguard the quality of the assets that these companies are creating. When you look at the sources of their funding, a large part of their funding comes from borrowing, and their borrowings are mostly debentures and bank borrowings. It's equally true for NBFCs and HFCs. Debentures, bank borrowings, and a lot of these banks are public banks. And hence, at the end of the day, I'm reiterating the same point that when a housing finance company gives out loan to people, it is common people's money, which is being put at risk. Although for a very good reason, because we need these HFCs and we need to understand what kind of risks they're exposed to. The academic literature in this area has been talking about two major types of risks that lenders and eventually the ultimate cash surplus units, that is common public, is exposed to. One of the risks that we have well acquainted ourselves with is the risk of default. You give out a loan to someone and the person is not going to pay back the full amount that is owed. So you could, as a lender, either receive a partial payment or no payment whatsoever. That is default. And there has been a lot of talk about default in the Indian economic circles, at least for last 10 years. And we seem to have a decent idea about default. But another major risk that these portfolios are exposed to are called prepayment risk. You gave out a loan for 30 years to a borrower, and she comes back and pays off everything in 10 years. That is prepayment. The question is, why could prepayment be a risk? And when I ask this question to my students at school, they come up with all sorts of descriptions and explanations of why prepayment is a risk. I mean, if you think about it, you gave loan to someone else, and the guy took this loan from you for 30 years, and he's perhaps being a very good person to come back much sooner and give you back all the money. Well, the problem here is that if lending money is the business that you're in, then prepayment means that you suddenly have to redeploy that capital. So for a long time, that capital will have an opportunity cost until you redeploy it. And the process of redeployment will have friction costs. And it will come with additional costs that you're exposed to. Default risk can be common in all sorts of markets. It is common in markets which are dominated by fixed rate loans. It is dominant in markets which are characterized by floating rate loans. Now, for last 10 or 15 years in India, we have almost forgotten about something called a fixed rate loan, right? So very few banks, in fact, to my knowledge, none of the banks in India is offering mortgage loans as a fixed rate loan. And that means that most of our loans are floating rate loans. The interest rate is tied to some benchmark. And then if the interest rates go up, your interest rate on the mortgage loan will also go up. If the interest rate falls, you hope that the mortgage rate will fall. The reality is that many lenders are very sluggish about it. So when it comes to increasing the interest rate, they are very agile. When it comes to decreasing it, it's often up to you as borrowers to go and ask them to reduce the rate. Nevertheless, if in India, most of the loans are floating rate mortgage, should we still worry about prepayment in loans? So if you think about it, when is it that people prepay the loans? There are two scenarios when a borrower would decide to prepay a mortgage loan. First is a common socio-cultural phenomenon. I just want to sell my home. If I want to sell it, I have to prepay the loan and get rid of the mortgage. Or the second is that I have signed a fixed rate mortgage at a very high rate, and now suddenly the market rates have fallen down. I don't like it because my neighbor next door is paying a lower interest rate for a very similar home, whereas I'm paying a very high interest rate. So I will have a tendency either to prepay the loan and get rid of an expensive loan when the interest rates have fallen, or I will transfer my balance from the current bank to another bank. And the third possibility is that I will go and renegotiate with my existing bank and ask them for a lower interest rate loan. You would argue that if in India, interest rates are floating rate, should we really worry about prepayment? And I'm going to build an argument for why we should still worry about prepayments. The problem is that our defaults have been increasing for sure. If you look at the gross NPA and net NPA ratios, they have not been at a very healthy level in recent years. Gross NPA is simply the amount that come as bad debt that you have to eventually write off. And net NPA is how much in excess you have written off compared to what the loans that actually went bad. And you see that, if the lenders were prudent, you should expect net NPAs to be negative sometimes. Sometimes at least there should be some instances where the lender should have over-provisioned. But it appears that they have almost always under-provisioned. And that issue has been in the news for a while. Then you see that in the affordable segment in 2021, the default rate increased all the way to 7.2%. That's a pretty bad news for an economy. And this is how much the HFCs have been provisioning for in the last few years. And if you see here, between 2019 and 20, the provisions fell by minus 12.5%. But then in the following year, they increased by 757%. The provision amount increased 8-folds. Now, this data is slightly biased because one of the HFCs that whose data is included here, went bust and, it had some issues. But still, the default rates have been increasing, and they have been increasing very bad, especially after the peak of the pandemic last year. Now, this is where people like us, academics, get excited because A, we recognize that there is a problem of default, and B, we have to think about what is causing these defaults. Are these defaults simply random? So if you think about how chartered accountants or accountants in general provision for defaults, the general practice is that we will take a certain percentage of the account receivables and allocate it towards provisions, right? Or allowance for doubtful debt. But what we are arguing through our research here is that we could do better than that, because it clearly appears from the previous slide that this provision has not been perfect and it has been biased. It has been systematically biased. So through our research, what we are trying to argue is that can we become more scientific about how much to provision for, so that next year when we actually record the bad debts, we can confidently say that our provisions were very close to what actually happened. In other words, can we predict these loan hazards? So from now onwards, the incidence of a prepayment in a loan or default in a loan would be considered as hazards. And I've built a case for why both of these scenarios are hazardous for a lending institution. So as academics, we love to see patterns. If we can see pattern, then we can extrapolate it. We will take a small sample of data. We will see if there is a pattern related to issuance of loans, or if there is a pattern related to the hazards in the loan. So let's focus on defaults first. In December 2020, there was this news from Mint, and it said that in the premium segment, the default rate was 3%. This is higher than usual average. It said that in the affordable segment, the default was 2.56%. This is only slightly higher than the norm. And in the mid-range segment, the default rate was 2%. Now, this is exciting for us as researchers, because now suddenly we see a pattern. We see that, in different segments, there is a different propensity of the borrowers to default on the loan. We can use this information for a predictive model. And then tomorrow, we can see we can randomly pick a loan, and we can say, we can categorize it in one of these 3 boxes. And accordingly, we can build our expectation of what is the probability of default in that particular loan. Now, the question is, where exactly should we be looking for patterns? Is the loan type the only thing that would determine the probability of default? The answer is no. So here is this news from Economic Times, 10th February 2021. It said that 23% of the 5 lakh crore home loans that SBI issued were takeover loans. In other words, they were not the originators of the loan. They bought big portfolios of loans from other lenders. Now, this suddenly makes you think that if the loans were not originated by them, what was the quality of the loan underwriting in the first place? Do they have a strong handle on the risk assessment or the underwriting of the loans that was done by a third-party lender? If you see further, the bullet point says that almost 42% of the SBI's home loans were customers under the age of 40 years. Now, we are trying to look at some patterns, okay? Almost 66% of the customers belong to salaried class, okay? So SBI seems to be a company, seems to be a lender, which gives loan to younger people and which tends to give loan to salaried class, okay? And 25% of their loans are bought from third parties. And then we see that in SBI, less than 1% of the book was non-performing. Okay, it appears that SBIC is doing slightly better than many of its competitors when it comes to defaults. And we further see that defaults are lower among 45 and above segment and the highest among borrowers below 25. Now, certainly a lot of patterns starts to emerge. One is related to the characteristics of the borrower. Another is simply related to the selection of specific types of borrowers by a lender. So that made us wonder more about how have these NPAs evolved over time. In this graph, you can see that there are three types of housing loans that we could think of. One is the most simple home loan, mortgage loans. Next is loan against a property. And the third is construction finance. And we see that in home loans, in mortgage loans, in traditional mortgage loans, default rates are the lowest comparatively. And in construction finance, they are the highest. So we are talking about companies who are borrowing money from builders and developers who are going bust. And we have seen a lot of news there. But now we see another pattern. And it clearly appears that the purpose of the loan and the profile of the borrower seems to be leading towards significant differences in propensities of the borrower to default on the loan. So this is all about the default. Next comes a very interesting development in Indian real estate market. NHB is working towards creating an SPV, which will start to securitize residential mortgage loans in India. This is an exciting development. As a student of real estate, I'm very excited about it because this is going to democratize not only the mortgage market for the borrowers, but also for the investors. As of now, investing in mortgage loans has mostly been in the hands of big ticket institutional investors or high net worth individuals because the ticket size itself is huge. If we are able to securitize them, then common janta, common public will also be able to invest in these types of, they can also take exposure to mortgage loans. But an interesting part about NHB's SPV is, and I've overheard this, that there may be a possibility that the fixed rate mortgage will come back to the market. Because a lot of the securities that they will create will perhaps, rearrange the cash flow in such a fashion that it will facilitate introduction of fixed rate mortgages in India, which pretty much sounds like something from the ice age in today's India. That means that if we are going to have fixed rate mortgage, then we may likely be exposed to the prepayment risk also. So I'm going to skip this slide about how exactly securitization of loan works, but the basic idea is that there is a cash surplus unit and there is a cash deficit unit. And basically, there are people who will go and borrow money from a lender as a mortgage loan. That lender will sell a large portfolio of these mortgage loans to a third-party securitizer. Usually, it is an SPV of an investment bank. Or in the US, it is a government-sponsored enterprise like Fannie Mae and Freddie Mac. And they will work with some merchant banker, and they will rearrange the cash flow, create different pools, and slice the pool into smaller pies. And each pie will sort of work like, for a lack of words, a bond. You could call them mortgage-backed bond. And whatever money, whatever cash flow is received from the borrowers can be transferred to people who buy these bonds. And these bonds have different characteristics. So this is the basic structure of securitization market. In India, securitization hasn't really picked up very well so far. When we talk about securitization, in true sense, there have been very few attempts for securitization. Most of the times, there is no pooling and rearrangement of cash flow. Rather, there is direct assignment of a portfolio of loans from one lender to another investor. For example, SBI home loans would come and buy a whole portfolio of loans from let's say, for a lack of words, Bank of Baroda, just for the sake of example. And we see that during the pandemic, the securitization has come down, but we are hopeful that this securitization will continue to go up, especially with the intervention of National Housing Bank in India. Securitization does not only happen in the sector of housing loan. It happens in all sorts of loans and in all sorts of instruments that entitle an investor to a series of future cash flows. So for example, if you see here, these are share of mortgage-backed securities originated by HFCs, and you see that yes, there are a lot of mortgage loans that have been securitized, but there are a lot of commercial vehicles, small business loans, microfinance, tractor loans, gold loans that have also been securitized. But a major chunk of the securitization goes to the housing market. So no matter what kind of institution we are talking about, we have to consider our risk exposure that we are kind of just passing on to common public and think about how to protect ourselves from those risks. So if prepayment is going to be a material risk for investors in India, then how do we forecast the prepayment? Traditionally, the prepayment models are too simplistic. And when I say simplistic, I'm almost talking about it sarcastically. Because, for example, the standards that the analysts follow would be something like what we call as PSA, Public Securities Association. So on the x-axis, this is the number of months since a loan has been originated. And on the y-axis, this is, you could think of it as probability of prepayment or probability of any default. And it simplifies the whole phenomenon by saying that in the first 30 months, the probability of hazard will linearly increase, and then it will plateau at a certain level. If you believe that this is too conservative, you can say instead of 100% PSA, I go for 150% PSA. All you do is multiply all these probabilities by 1.5. Or if you believe that this 100% PSA is too aggressive, you can go for 50% PSA. Long story short, this whole phenomenon of predicting loan hazards is too simplistic to be true. And this is the problem that we are trying to solve through our empirical research work. Because when we look at prepayment hazards in multifamily loans, this data comes from United States, we see that the pattern is clearly not linear. So you could interpret this graph as follows in a very rough fashion. X-axis is the number of months since the loan has been issued, and y-axis is what is the probability that the loan will survive. For example, if I pick 60 months here, go to the y-axis, and I see that survival probability is around 0.5%, we could roughly say that by the end of the 60th month, by the end of 5 years, 50% of the loans have already met with a hazard. Now, when you look at this pattern here, it's very clear that indeed in fixed rate mortgages, the survival rates are very high for a very long time horizon. And in floating rate mortgages, it falls, and it falls very drastically, right? So when it comes to, and here we are talking about prepayment hazard. And in floating rate mortgages, the survival rates can fall very, very quickly. In other words, they can meet with hazards much sooner than fixed rate mortgages. So this finding comes from our paper that I co-authored with my colleague, Dr. Julia Freibote. We were very fortunate. This one paper has won us 3 international awards for a simple reason that we tried to think out of the box. And we said that whatever we have traditionally thought as the determinants of loan hazards may be an incomplete story. We said that we as human beings are prone to psychological biases. And in addition to a lot of macroeconomic fundamentals like interest rates and the volatility in the stock market, etc., we should also consider public market sentiment, investor sentiment, and also see if those investor sentiments cause additional propensity for people to prepay these loans or default on this loan. So this particular paper focused on prepayment, and I will not overwhelm you with all these numbers. All I'm trying to show you here is that when the underlying asset value grows, when the asset value grows, and when the market risk is also growing at the same time. Higher the risk, higher the return. So there is a high probability that when you see a positive return in your asset, perhaps there is more volatility in the market and there's more uncertainty in the market as well. In those scenarios, whether it is a fixed rate loan or a floating rate loan, the probability of hazard comes down. And here the hazard is prepayment. So people only prepay when they are fairly certain about the market. So it's sort of a bullish strategy of people to prepay on the mortgage loans. What we also find is that the sensitivity to the interest rate movement, as expected in terms of people's propensity to prepay on a loan, is more in fixed rate loans than in floating rate loans. And this is precisely why in India, we haven't seen prepayment as a major loan hazard. But if fixed rate mortgages are introduced, we should expect that there will be a lot of prepayments. And the newspapers will also start talking about prepayments in loans as they're talking about NPAs today. But more interestingly, we found that in addition to these market fundamentals, risk in the market, macroeconomic factors, and growth in the asset value, it doesn't matter what kind of loan we are talking about, whether it is a fixed rate loan or a floating rate loan. If the market sentiment is positive, people will have a significantly higher propensity to prepay on the loans. And when we look at the fit of these models, the predictive power of these models is quite high. So this paper was more about prepayment hazards in mortgage loans in the United States. More recently, we have started working on a different paper. This is still a work in progress. And here we are looking at the demographics of default. So in this study, we are focusing on a different type of hazard, which is the hazard of loan default, because this is what we see more of in India. And this paper, we are working collaboratively with Professor Abhiman Das. I am Ahmedabad, Professor Chinmoy Ghosh at University of Connecticut, and Divesh Pandey, who is a research associate at Mishra Center. Now, this paper is not really so much about our ability as lending institution to predict the loans, but it is more about explaining what are the factors that lead to the defaults in loans. We apply an econometric method called survival method, Cox proportional hazard method. This research work is still in progress, but we have some findings and I would like to share some of those findings with you. So we started with non-parametric analysis. In other words, we are focusing purely on the sample and we are not trying to extrapolate this sample to the overall population. But the good news is that our sample is very large. Our data comes from a particular lender, which is a very large mortgage lender. And we are talking about millions of observations that we have. So when you look at this graph, we are comparing the propensity of defaulting on the loan between male and female mortgage loan borrowers. And you see that the propensity does not seem to be significantly different from each other. We do see some evidence that female borrowers tend to have slightly, are associated with slightly lower survival rates after the loan has crossed the maturity, its tenure of around 2,000 days, that is around 6 to 7 years. In the next step, we try to examine if people's social identity also can be associated with different types of propensity towards defaulting on the loan. As social scientists, we simply try to study what is there in the market. We don't want to draw judgments from it. We simply want to see if there is a problem area and if policy initiatives should focus on addressing those problem areas. For example, right here, if we say that suppose the graphs were significantly different between males and females, suppose this was the graph of female, just to cook it up. That clearly showed that there is a higher propensity of default associated with female borrowers. So does it mean that lenders should stop lending money to female borrowers? Because at the end of the day, lenders owe their allegiance to the equity holders. Their job is to maximize the value of the shareholders. But if they do that, that would be a discriminatory practice. So this is a catch-22 situation. On the one hand, we can identify that one segment of the society has a higher propensity to default on the loan, while the other does not have. Wouldn't it make it a natural process that lenders inadvertently or advertently will lean towards one segment of the society, which is associated with lower propensity to default on the loan? This simply means that the policy interventions must come in place and make sure that the loan disbursement policies are equitable across all segments of the society. So before I am going to show you upcoming slides, I just want to clarify what is the purpose behind us examining this, because these are areas that need attention in the society. And when we focus attention on the society, we can take care of the investors' concerns as well. So in the next set of analysis, we examined if the borrower's caste identity also has any significant association with default. And we see that there is a clearly significant difference in the survival of mortgage loans across people of different caste identities. In the next set of analysis, we examine survival probabilities by professions. And again, we see that different professions have different propensities towards default. For example, as we can see here in our sample, which is a very large sample, we see that if the borrower is earmarked as a housewife, the survival of the loan is significantly lower in longer horizons of the loan. When the borrower is a government employee or a PSU employee, the propensity for default is significantly lower over time. And in the next set of graph, we look at religion, faith of the borrower, and we again see that there are significant differences across different segments of the society. Now, once we conducted this analysis, we realized that there is definitely some sort of a crisis, some sort of a problem that we are faced with as a national economy. And then we wondered what could cause the differences across different social segments and their association towards defaulting on a loan, because this is an issue that needs to be addressed. We looked up a lot of literature. Very many studies of similar nature have been conducted in the United States, where people have looked at race, sexual orientation, profession, and linguistic backgrounds of the borrowers, and similar findings have been reported there as well. So there are two possible explanations for why we observe these significant differences across different strata of the society. And one of the explanations is quite contentious. The second explanation is that this is not really about people's social identity. This is not about the gender. This is not about people's religious faith. This is not about their caste. This is not about their profession. This is about something else. And that something else, as you might have rightly guessed, is nothing but people's credit score. So in the next step, we included credit scores of all the borrowers in the model. And we found that after including the credit score, a lot of these differences across different segments of the society actually vanishes. Not completely. In some cases, it even reverses. In some cases, it totally goes away. And in some cases, the significance goes down very, very low. So although as academic researchers, our job is not to keep any bias towards our results, as of now, we are very, very happy to get these results, because what these tell us is that nothing else matters. If we can empower different segments of the society to the same level so that they can have similar credit scores, then lenders or the financial markets do not have to worry about about potential discriminatory practices when it comes to giving out loan to borrowers. So long story short, I'm going to summarize my talk today. The first message that I want to convey is that housing loan is a large part of NBFC and HFC. And when Mr. Adukia creates a group on WhatsApp and a community of chartered accountants who focus on housing sector, that's such a wonderful news, because this is a sector that needs more attention. We need to have more educational programs related to real estate, both on the equity, lending, valuation, and investment sides. And we also saw that both prepayment and default are material risks to the asset quality if we focus purely on the lending market. And the traditional methods of predicting these loan hazards can be improved. And we have shown evidence using two different contexts of research that we, with a very decent degree of accuracy, should be able to predict the default in a loan. And that will help improve the financial markets that are associated with mortgage loans. And the application of these methods will lead to a lot of social goods. First is that it will help improve the quality of the assets that are created from mortgage loans. Secondly, it may help us reduce discriminatory lending practices, because we clearly saw that social identities have a little role to play. It's just the economics, is the economy stupid, as one of the American presidents had rightly said. And if we are able to come up with sophisticated models for predicting loan hazards, that is going to help with securitization of the loan and further democratization of housing finance in India. On that note, I will complete my talk here. Thank you very much for your attention. If you have any questions, I'm here.
So for your information, we have got 1,043 viewers. You can see there in the box down over there.
Impressive.
Mm-hmm.
That's your prowess, Mr. Khan.
So one thing, I just was curious, and I was waiting for this moment that you come up, that you are done with your presentation. So what type of loan do you suggest to the consumers? Because see, the chartered would have two kinds of people approaching. Okay, one from the consumer side, one from the service provider side. So when I go to them as a buyer and I'm seeking for loans, the options that I have seen, like there are fixed interest and there are floating interest. So as a, when I go down, what points I should keep in mind while suggesting what kind of the plan for availing the housing loan, the mortgage loan I should go for.
Now, Mr. Khan, I've been writing about this topic for a while. I would encourage the audience to go to my website. It's prashantdas.com. And I have a bunch of articles in which I have talked about issues that relate to your question. Your question in particular is about selecting between a floating rate loan versus a fixed rate loan. The reality is that in India, fixed rate loans are a rarity. Honestly, I have not found any serious lender who is indeed giving out fixed rate mortgage. What you do get is a hybrid loan, wherein for the first few years, you can fix your interest rate, and after that, it will become floating. This was not the case around 12, 13 years ago in India. At that time, banks were offering fixed rate loan. So I don't really think that public has a choice here. Everyone is essentially, most of the people are essentially going for floating rate loans in India. But if you did have a choice, what would you pick? That is a question. And this is a real question of selection among borrowers in the developed countries. Yes, Mr. Khan.
Sir, I'm listening to you, sir.
Okay. The rule of finance, as we all know, is very simple. Higher the risk, higher the reward. One of my friends, Dr. Dongshin Kim in the US, was doing a study on, in the long run, what happens. If you take a floating rate mortgage, so let's take two simple examples. Mr. Salim Khan goes and gets a fixed rate mortgage at 8%. Prashant Das goes and takes a floating rate mortgage. And by design, the lender has to give some cookies to Prashant Das. Because if I'm taking a floating rate mortgage, I'm the one who is taking all the interest rate risk. If the interest rate goes up, my interest rate goes up, my mortgage rate goes up, and the lender's margin remains intact. Whereas in your case, the interest rate risk is being borne by the lender. So the lender will have to make it more expensive for you. Right? In my case, there is uncertainty. There may be some time periods when the interest rates will go up. There will be some time periods when the interest rates may fall below 6%, at which I originally started my loan. So the empirical question is, in the long run, what happens? Is it that if I start at 6%, more or less throughout my 20 years of mortgage life, will it stay at 6%? Will it go up? Will it go beyond 8%, which is your interest rate, or will it stay below 8%, right? Empirically, it has been found that indeed people who go for floating rate mortgage end up paying less in the name of interest. So if Mr. Salim Khan on a fixed rate mortgage pays 8% interest for 20 years, and my interest rate fluctuates from 6% to maybe 10% and sometimes 4%, effectively in the long run, perhaps I'm only paying 7%.
Fantastic.
So this is an empirical finding, but that does not guarantee that if you're going for a floating rate, your cost of capital is going to stay low.
So in India, which city you look as a good investment prospect when it comes to real estate?
So if you ask me, I don't see almost any city as a good place for real estate investment.
That's interesting.
I'm
all ears now.
So as a student of real estate in India, I mostly see real estate investment as a consumption good rather than an investment good. And let's face it, people's motivation to buy real estate are multiple. There are some people who are faced with some degree of insecurity socially. It could be due to their, let's say, social identity. It could be due to their volatile income pattern. It could simply be because they could be marginalized in the society, or they are at the risk of being marginalized. So many of them find home to be their castle. So I'm not arguing that buying home by itself is an irrational decision. What I'm arguing is that buying a home as an investment good requires a great deal of analysis. So I teach this to my students here, where we do a buy versus rent analysis over a long run. And in most cases, we end up concluding that renting a home economically is a better solution than buying it. Now, let's take a simple example. Suppose Mr. Salim Khan goes and buys an apartment in Mumbai for 1 crore rupees. Or let's say 120 lakh rupees, 1.2 crore. You go to a bank and they give you 80% loan to value ratio. So you get around 1 crore in loan. On that 1 crore, you are paying an interest of around 10%. Right? So every year, your interest itself is 10 lakhs. That is what you're paying in interest. Now think about you buying that home and renting it out to someone else. When you rent the same apartment to someone else, you'll perhaps get 30,000 in rent for that apartment. On an annual basis, this is around 3.5 lakhs. But then you have expenses. You'll be paying for property taxes, you'll be paying for maintenance, you'll be paying for housing society cost. The net effect is that the rental yield on your home will be sub 2%. So you're paying a cost of 10% and your rental yield is 2%. Combine these two together, in general, you are making a loss of -8% every year. Now, to compensate for that 8%, you should expect that the asset value should increase by 8% every year. Is that really happening? When you look at NHB's Residex, in last 15 years, 10 or 11 years, the CAGR in homes has been around 4 to 5%. So let's say optimistically you have 5% asset price growth, and let's say optimistically you have 3% in rental yield. You're making 7% return. So 7% is a return, and around 8 to 10% is a cost of capital. So every year you're losing 1%. So how does it make a wonderful investment good? On the top of that, you have the risk of dealing with a tenant. We have all sorts of tenant litigation. You have a problem of encroachment, and you have a bunch of other problems that are associated with owning an asset like this. If instead you had invested this money in ETF, you had guaranteed return of, I don't know, 10 to, depending on, so I'm not trying to make a blanket statement. It is not true that investing in home is always a bad idea. You may be smart enough to find the right opportunities. For example, in peri-urban areas where the land prices are still suppressed, you may consider buying a home there. And there, perhaps there is a higher likelihood that as the society matures, as the area gets gentrified, over time, the asset price appreciation will be good enough for you to reap some of the benefits. But when it comes to the ease of increasing your wealth, perhaps that itself, in most cases, should not be your main motivation to buy a home. If you want to invest in real estate, there are REITs, and inshallah, there will be CMBS and an RMBS coming in the market. So you never know.
Yes, this was always a question in my mind, and you have given the same insight what I received from the other professionals. In fact, you elaborated it in more detail. So here it goes into my brains, and I know now what call to take on this, sir. So we still have around 6 minutes, and I don't see any questions coming up. And the reason would be that you have done it so nicely that everything has been understood, and I was listening to your entire session. So something in a nutshell for the the participants over here. Something in a nutshell, and then we'll conclude.
Yes. As we say that real estate is our castle. Home is our castle.
Right.
So buying homes can still be beneficial on many fronts for many people. But in addition to buying homes, I would also like to draw our audience's attention to a very specific type of product that the National Housing Bank introduced perhaps half a decade ago. And that is called reverse annuity mortgage, RAM. This is a product that never ceases to surprise me. What surprises me is the beauty of this product. And what also surprises me is the incredible disinterest among Indian citizens towards this product. What is a reverse annuity mortgage? If you think about it, let me explain what RAM is, reverse annuity mortgage. I am Mr. XYZ, and I own a home. When I own a home, perhaps I have paid a lot of mortgage payments for this. I've perhaps paid 10% interest on my mortgage loan for last 20 years. Eventually, I'm able to own this home. This home is worth 1 crore rupees. And then when it is the time to start enjoying, reaping the luxuries of owning my home, because perhaps I've been working all over the place, I've been traveling abroad or different parts of India. I never got a chance to live in my own home. Now I'm retired and I want to live in this home. Think about it. Most of my life's savings for a typical middle class family goes into an asset that I will not be able to consume throughout my lifetime. I retire at 60, maybe I have 30 more years to live. When I die at 90, that asset is still there on the face of the earth. That clearly shows that I have left a lot of asset, a lot of my wealth unconsumed. I have never consumed it. After I retire, my income has gone down. If my income was, monthly salary was 50,000, now it has come down to 20,000. So I have to compromise on my lifestyle. I look at my asset every day only to realize that I have built something that I will not be able to consume throughout my life. Now, many people argue that, hey, if I don't consume it, my kids are going to inherit that home from me. But think about it. In today's middle class India, how many of your kids are actually going to live in the home that you bought or that you lived in? If that is the proposition that you have, isn't there a possibility that you're rather creating a constraint for your kids? Isn't there a possibility that your kids would want to live in Bangalore and not in Mumbai where you bought a home? Or maybe you bought your home in a second-tier city, but your kids decide to go abroad. So for them, maintaining the ownership of this home in many cases is going to be a pain in the neck. You're not giving them an asset, you're also giving them an asset which is packaged with a lot of trouble. Instead, wouldn't it have been great if you had rather given them liquidity instead of that? So what reverse mortgage annuity allows you is exactly this, that after I retire, let's say at 60, I reverse mortgage my loan to a bank. The bank comes in, assesses the value of my asset, says it's worth 1 crore. They write a loan of, let's say, 60 lakhs for me. Now I can take that 60 lakhs as lump sum and use it to supplement my retirement life. I may have health needs. I may simply want to spend money on my kids and my grandkids. I want that liquidity. And let's say that loan matures in 10 years. So in these 10 years, I could either take all the lump sum today, 60 lakhs today, or I could convert it into an annuity such that it will add up to 60 lakhs at the end of 10 years. And at the end of 10 years, when the loan matures, many people worry that, oh my goodness, the bank will come knock at our door and evict us from our facility. No, regulations protect reverse annuity mortgagers from eviction. I can possess my property until I'm alive. And if I die, my wife is entitled to possess that property until the end of her own life. So my tenure is protected. I get annuities every month. And let's say both my wife and our life has ended at the end of 100 years. That asset is still there and I have an heir. So the bank will come and negotiate with my heir. If the heir wants to buy this property out, not of any economically rational decision, maybe for emotional reasons, they can simply buy it out. Or the bank will go liquidate the asset, take its own 60 lakhs and give the remaining to my heirs. And God willing, in next 30, 40 years, this 1 crore property will become 3 crores. So my heir is not tied to a physical asset that she or he may not be able to use himself or herself. She moves away with the 2.5 crore rupees, right? And I lived my life respectfully. I didn't have to depend on anyone. I did not have to compromise on my lifestyle. And then it is good for everyone. The bank gets business to do. It earns some interest. I'm able to consume my asset. My kids are able to enjoy their freedom in their lives. And we all live happily ever after. So I would really encourage those who are enthused about real estate investment to please explore the option of reverse annuity mortgage. Many branches are offering it. Many branches of the banks may not be aware of it. In that case, you can go and cajole them and ask them to give you a reverse annuity mortgage. So I guess I have exploited my time, Mr. Khan.
Yeah,
as a professor, I can keep talking. So,
so Professor Prashant, thank you so much. And on behalf of the entire Committee on Economic Commercial Laws and Economic Advisory, Chairman C. Dr. Rajkumar Adukia, Vice Chairman Harsashram, I thank all the participants over here. And, a special thanks to the speakers who have come here on a weekend and, they have given their time just for the, giving enlightenment to all of us. And this was really a very nice session. Thank you so much.
Thank you very much. Really enjoyed it.